Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Contrarian Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
If you're an advisor looking for real diversification, here's a question. What's been one of the most consistent inflation-beating investments for the past 30 years? Farmland. According to the National Council of Real Estate Investment Fiduciaries, in the past 33 years, farmland has delivered over 10% annualized returns with less than 7% volatility. That's lower than stocks, bonds, and commercial real estate, and yet less than 3% of U.S. farmland is institutionally owned. That's where Farmland LP comes in. They take high-quality farmland and convert it to organic and regenerative agriculture, potentially increasing land values and cash flow. They're hosting a webinar for RIAs on March 12th to break down why farmland is gaining traction as an alternative investment, how it fits into client portfolios, and how you can get exposure to farmland through their Fund 3. Reserve your spot now at the Farmland LP link on my podcast page or email irteam@farmlandlp.com and tell them you heard it here on the Meb Faber Show. Past performance does not guarantee future results. Welcome back, everybody. We got a legend joining us today. Our guest is Chuck Clough, Chief Investment Officer at Clough Capital. He's been in finance for a number of decades, is well known from his time as Chief Global Investment Strategist at Merrill Lynch. After that, he started his own firm, Clough Capital, has been running it ever since. Today, we're going to talk about his illustrious career, get into what the investment landscape looks like today. Chuck, welcome to the show.
Thank you, Meb.
I'm super excited to talk to you today. Before we get into this crazy world we live in, I want to touch on a few things from your career. You got your start. We've had a number of Chicago grads on here, and many have worked with some super famous Nobel laureates, et cetera. You did too, but there were some slightly different ones. What was your origin story there? Who'd you get started with?
At the University of Chicago, I was very, very fortunate. It was actually on a quarterly system, and I finished a quarter early. And at that time, a very respected professor who I'd had classes with, George Stigler, was on early work on a price study that ultimately translated into the reason he received a Nobel Prize in 1982, which turned out to be on regulatory capture. But this particular study pointed out that the traditional price indices that we all use, which at the time were called the Consumer Price Index and the Producer Price Index, actually were badly designed. And they were designed to pick up list prices when actually the prices that were transferred oftentimes had discounts and freight allowances and a number of other factors. So the actual series of price cycles was quite more volatile. And a volatile series, if you start at the beginning and end at the end, will always end up lower than a straight line series would be. And that was an amazing insight. Out of that came any number of adjustments in the series. But we basically found out that over the years, the major price indices that people used at the time were actually inflated.
Where on the timeline? What years were you there?
I was there from 1964 to 1966. George actually won the Nobel Prize for proof that there was something called regulatory capture. In other words, that even though most people believe that business hates regulation, the reality is it loves regulation because the businesses that are regulated often end up capturing the regulatory body itself through transfers over the years and everything else. So business actually like regulation because it cuts back on competition. It was a brilliant insight.
As two people who are in what we call the ETF terror dome, it's interesting to see that perspective on competition. So the 60s rolled into the 70s. 70s, arguably one of the toughest times to be an investor. We've just gone through this experience in the US where interest rates were darn near zero. And then you've had this pretty quick move up, and everyone for at least a little while was starting to freak out about inflation, which if you look back to the 70s is almost cute in comparison. My favorite is when my wife was complaining to her father about mortgage rates. And he just smiled and laughed. He's like, that's cute compared to what we used to pay back in the day. Do you see any parallels, or what was the difference, the experience like as you rolled out of Chicago and then all of a sudden the 1970s, pretty different time as far as inflation and interest rates relative to today?
Quite a difference. And the reason, and we may get into this in more detail a little later, the reason is where demographics were then as opposed to where they are today. In the late 60s and in the early 70s, the baby boomers were entering the labor force and creating their families. And the baby boomers were, at the time, the largest borrowing and spending demographic ever in history. The baby boomers built the housing stock. There really wasn't a lot of single-family housing after World War II. And when they came on, they actually built the housing stock. It's been expanded and repaired since then and improved, but they built it, and they created a tremendous amount of debt doing it. So as you might think, excess debt and excess credit created inflation, and it was very deep-seated inflation. If you looked at private debt, and you can look at this in a general sense, private debt as a percentage of GDP was about 75% of GDP in the late 60s. By the early 80s, it was 150% of GDP. So you can see the enormous expansion in credit that happened in that time. And Milton Friedman's insight was that money creates inflation if there's too much of it. And there was a whole heck of a lot of it for a number of years. What we today call M3, it's not followed as much today as it was then, but that was the dominant money measure. It's M2 today. But it include bank certificates of deposit. So you could pick up all of the increase in mortgage credit that happened. It grew at 13 to 15% a year for several years, almost a decade. So of course you're going to have inflation. Today, it's nothing like that. Money supply is actually modest to negative in some areas, a lot of areas, especially abroad. And we're not building the housing stock. So the other thing about the 70s that stand out, it was up until that time, really outside of the Depression, it encompassed in 1973 and 74 the deepest bear market we'd experienced. The S&P was down 48, 50%, but it took 2.5 years to get there. I had friends in the business, we'd say years later to each other that if you live through the 73, 74 bear market, you're always a bear. Now, you might be a fully invested bear, but you're always a bear. And that was the psychology that came out of the 70s. And it took Paul Volcker a tremendous restriction of money growth as we went through the 80s, which I think would have happened anyway for reasons I'll talk about later, but it did. And of course, the inflation devil was gone. And of course, by the 90s, there was very little inflation, even though we had a boom in corporate spending for the dot-com boom. So it was an interesting decade. For most people, the only inflation experience they had was in the 70s. So the easy thing to do is to compare it with the 70s. But the dynamics were totally different. And we're not going to see anything like that again.
Your colleague said that I had to ask you about trading lumber in the 70s. You weren't a technical analysis guy, were you? And I know Bob Farrell was later. Is that the best way to hedge the inflation, trading lumber, or what?
Well, we did actually for a different reason. I was very involved in the building of the housing stock because there was so much demand for housing. You literally built the housing stock in that decade. So it was something that you just followed. And because I followed the economy and followed the behavior of prices, George Stigler sort of left me with that interest. I followed lumber. And we could see in 1973, of course, as interest rates rose, lumber prices started to come down because of overproduction and the fact that housing demand fell as interest rates rose. So you could see in the futures markets that was indicating that would be the case. So I had a very successful trade in lumber. Unfortunately, it was too successful because as the seasons continued, I thought I could try that again. And the story you may have heard, because I tell it a lot, sometimes when you make a tremendously bumbled mistake, you learn a lot about the capital markets. And I learned a lot about the commodities markets, but we held a position of short lumber, actually short, believing the price would go down. The day the contract expired, that was in the old Chicago Mercantile Exchange at the time, usually the contract would expire at 2 o'clock Eastern time, 1 o'clock Central time, of course, where the exchange was. But then about call, the contract I remember was trading high, and I thought it would go down the limit because you actually had to buy the lumber at that time. And it did, touch the limit and didn't give it another thought. I thought it would just expire that way. And I get a call after the lumber closed, and actually just a few minutes before the contract closed, and they informed me a little belatedly that the contract was going to close in 2 minutes. So I tried to cover, I remember there were 10 contracts, about 20 cars of lumber. In a millisecond, it went from down the limit to flat to up the limit. So basically, I ran it up the limit. And about a half hour later, I got a call from Payne Weber, it was, by the way. They're part of somebody else today. And, oh, you have to deliver 10 card loads of lumber, one for each of the contracts. And I remember saying, well, how do you do that? Well, you call a lumber mill in the Pacific Northwest and you tell them you need 10 cars of lumber. And I'll never forget the phone call because I did raise somebody at one of the lumber mills. And I could tell as soon as I opened my mouth, he knew who I was. And he screamed to the rest of the guys in his room, hey, I've got the guy who on the phone who really... So anyhow, it was a rather endearing thing to do. The idea was closed before it closed, but it's one of those things that teach you how capital markets work, and you make a mistake like that once, and I never did again.
It reminds me a little bit of a couple years ago when everyone was looking at oil futures as they traded negative. I said, why can't I just buy this? It's impossible. This trade's negative. And I said, well, you're going to have to do something with that at some point, right? You're going to have to take possession of that oil. You got a big backyard. I don't know, somewhere to put it. It's going to be tough to store, expensive.
Well, that's the issue. In my case, I had to get it. I had to get my hands on it. The story doesn't end there, by the way. I remember he also asked me, well, where do you want it delivered? Because there were certain delivery points in the Chicago Mercantile Exchange system. And so I said, well, what's the closest one to the mill? Well, it's in Kansas City. Well, then I said, okay, Kansas City is it. A few more minutes went by. Well, actually, another day went by, and they say, we got a problem. I said, what's that? Well, there's an avalanche, and the train is caught in the avalanche. It won't get out. And I said, well, what does that cost me? It'll cost you $100 a day per car. And I wasn't very wealthy at the time, so even that was some money. So I offered to get a shovel and shovel it out, but they eventually got the shovel out. So it was a comedy of errors, and it went on for several days.
Well, that leads us after this really difficult period. And listeners, I mean, 70s was tough for, particularly on a real basis, for just about anything. Gold being one of the few things that helped during that period. But that led to the 1980s. And 1980s, really the beginning secular of a 2-decade run. When did Merrill start for you?
I joined Merrill in March of 1987.
Okay. Oh, man, that's good timing, too, right before October 87.
6 months before October.
Yeah, what was the experience there? How was that October? You got any fond memories?
I'd been a strategist before, and of course, I started my investment career on Wall Street. I was an analyst for Donaldson, Lufkin, Jenrette.
DLJ?
DLJ, the famous DLJ. It was 7 or 8 years. I had been with Cowen and Company, another respected broker, but obviously not quite the footprint that Merrill had. So I joined that in March of 1987. There was some volatility building up in the markets, and we did get a sense that there was a lot of leverage built into the markets. The insurance trade has put together a number of so-called stop losses that could get disrupted as they ultimately did. So I got a little credit for actually being a little bit bearish. I really wasn't, because the underlying economy was very well, but it was apparently enough of the brokers built enough cash so they were able to survive the collapse itself. But I remember sitting in the trading floor at Merrill, watching all the sell orders came in, and the brokers had these cards, these small paper cards with little stock symbols. I mean, tons and tons of stock symbols. So there was a tremendous scramble for liquidity. The first one I'd seen like that. And it was over in a day, but it was a scary moment for a few hours. But people just had to sell stocks, especially if you were open-end mutual fund. And of course, the industry was dominated by open-end mutual funds. So they knew there'd be a lot of liquidations at the end of the year. And we saw a lot of fidelity orders come in that I would have thought they were impossible to execute, but apparently somehow Merrill managed to meet the needs of whatever client we had at the time.
So you got thrown right into the fire, though, having been done it already at a few other shops, but now at the Thundering Herd, and you kind of spent a lot of time there in a very formative bull market period, the 80s and 90s. How often do you talk to an investor, reporter, podcast host today where they say, Chuck, how much does this feel like the late 90s to you? I bet you get that question like once a day. And what do you say to them?
No, it's not remotely the same. I think just first of all, and by the way, that was a little bit of a bump in my career because we did get out of stocks before the dot-com boom was over. So people were nervous about that. But the dot-com boom was really the first massive technology boom. I mean, the only other technology boom I can remember up to that time was when the IBM 360 emerged in the 1960s, and it dispersed data processing, which means you could put a terminal on anybody's desk. You could never do that before. The large mainframes before that took a room to get going. So the 60s was a good decade to make money. It's a good decade to enter Wall Street. When you get to the 90s, it was a different game. This time we had personal computers, dispersed data processing, and of course the internet. It came on just like that. I mean, it seemed like it came on before Thanksgiving and Christmas in 1997, I kind of want to say. But the difference was when you really analyze the companies, it was a business model that was determined to fail. Essentially, you had to get what was called eyeballs, and the stocks were valued on the basis of how many people they had buying that product. But the problem is the cost would always outpace whatever revenues you generate from whatever use you had. In fact, you had companies that were in the plumbing business that said they were suddenly .com companies because they put up a website and stocks would run on no reason at all. It was a very unprofitable time for technology because the cost of building the internet was basically covered by many of these companies who were spending money they didn't have. So once they couldn't access the credit market, the capital markets, of course, the thing literally came apart. I remember there were stocks like Pets.com, a company that actually ABC bought it, and it showed up on the Super Bowl that year. They never made money, literally never made money. And when you look back now, only one company that was dominant in the dot-com boom, of which busted in 2000, 2001, only one company survived and went on to being a much larger entity. A number of other companies survived, but today they're shadows of their former self. But the only company that went on to capture other technology advancements was Microsoft, one company. Actually, there were two. Apple was the other one that also survived. But the reason was they had the operating systems. And I think this is the secret to how the FANGs will work out. They had the operating systems. And what that meant is that they could put out product and they could put out software in such a way that they could capture the revenue streams. And they captured the bulk of them. But those are the only two companies that went on to become dominant companies on the post-dot-com boom.
So you feel like this time's a little different. I think you have these giant companies now. People love to try and make analogies in markets more than anything. Say, hey, this feels similar to this time. Therefore, I can kind of predict the future and what's going to happen. Talk to us a little bit about some of the companies today. Do the Googles and Mag 7s of the world feel similar to some of these companies or not so much?
Let's start with the comment that I left. There were two large companies. By the way, there were other companies that survived the dot-com boom and went on. Cisco was one and Oracle was another, but they never expanded from that point. They're shadows of their former selves today. And understanding how the operating system allowed these companies to capture revenues, and more importantly, to capture revenues and have such an advantage over competition. If you remember, Netscape was the first browser, a company to create a browser, and Microsoft had no problem eliminating them, literally because they were in everybody's computer. So you could easily throw out software as a way of generating revenues. There's a similarity today, and the way I feel it will work out is start with what happened when the Fed accelerated the liquidity flow into the markets in late 2020 and 2021. You had a tremendous boom, and it was in technology because that was the new thing in the block. Out of that period came, I don't know, it must have been hundreds of software companies had IPOs, software companies for all sorts of magic little things. And they all boomed in 20 and 21, and they all collapsed in 2022, along with the large hyperscalers, the large cap tech stocks. But in 23 and 24, the FANGs came back, the large cap tech companies with a solid base, and the software companies didn't. There's an ETF, the symbol is WCLD, that captures that dynamic. It's all of the companies that were basically in most software lists, including Snowflake, which was actually a pretty good company. And they all boomed, they all gave it back, but they never really came back. And to this day, the WCLD is kind of trading in low range along its base. And of course, the FANGs have gone on greater and greater things. So I think the same dynamic will work out. And the way I think it will work out is, let's say if we go into AI, the question again is who's going to generate revenues and not have the same cost issues that so many of the dot-com companies have. It always costs more to create that product and deliver it, unless you had a special advantage. And I think it's the hyperscalers, largely the companies that dominate the cloud. Amazon, Microsoft, Google, and Meta's found a clever way of accomplishing the same dynamic. So there are four of them. The question, who will actually deliver the application software? And they will have an immense advantage, it seems to me. Think of a pyramid, for example, and along the bottom is where most of the profits are. And that's the hyperscalers. As you get closer and closer to the top, you're getting closer and closer to the companies that deliver application software. And I like to use this little anomaly, this little metaphor. Let's assume you've got the best artificial intelligence program for bankruptcy lawyers. It works better for bankruptcy lawyers than any other artificial intelligence product in the world. But the problem is there aren't that many bankruptcy lawyers. So just like in 21, 22, none of those software companies got scale. The only ones that will get scale, I think, are the hyperscalers, because they can throw out software at the speed of light very, very quickly and reach everybody. And I'm convinced that's kind of the way it will work out. And the likelihood that, well, if you think back to the large software companies and who survived, it was a handful. ServiceNow, CRM, and I think that'll be the case in the AI world. The hyperscalers will dominate the ability to deliver software very inexpensively, and they will capture most of the profits. I think some of the semiconductor companies will as well, because there's so much proprietary capability there. But I think there will be hundreds of software companies with AI programs that don't make it.
It's always interesting as you're kind of sifting through some of the companies. You have the ones, obviously, that have a bunch of cash flow today, but even the ones back in the late 90s, you mentioned Cisco, and you had a great quote when you were talking about Cisco. Cisco, just a very real business, but at the time just got to be really expensive. And you said, when I first started going negative, the stock went up 6 times before it declined 95% from its high of $82 in March 2000 to less than $10 in late 2003. How would you talk about that period, but also how do you remain steadfast on like a position or a market call on something like that when it goes against you that much? But also, as you think about some expensive names today, may have a real business, but it's just to the point where it's moonshot levels of valuation.
Let me fill out the rest of the story about the Cisco. And I'm talking in 1998, 1999. And of course, the valuation divergences were infinitely larger than they are today. I mean, Meta's at 22 times earnings. You can easily, and Google's at 22 times earnings. You can easily justify that kind of multiple. It was nothing like the dot-com boom in terms of valuations, especially relative to cash flow. One of the characteristics of large cap tech hyperscalers today is they generate huge, huge amounts of cash flow. And if Amazon ever paid out the same percentage of cash flow that, say, some of the other technology companies does, it would have a huge yield. So a lot of it's actually being held on the balance sheets right now, which makes hyperscaling very profitable. I recommended Great Western Financial because the divergences in valuation was so different. And that was the dominant savings and loan company at the world. It was run by the Sandlers, a great management team, and it was 5 times earnings. And Cisco was 80 times earnings. Well, what happened, of course, is a little early. By April of 2020, Cisco had gone up 6 times, and Great Western Financial fell 50% because money just went into the tech sectors. Well, in the subsequent 18 months, Cisco went down 95%, as you note, and Great Western Finance went up 6 times. So that gives you an idea of how powerful liquidity was beginning and how fast sentiment was going. Because all the time, there's nothing wrong with Great Western Finance. It was still financing houses and building mortgages and getting good spreads. I was told that Cisco built 6 fiber loops around the city of Boston. And I was told not too long ago, those fiber loops still there, but they're running at about 40% of capacity because the technology always expanded, that the same fiber could handle much more data as time went on. So eventually, the building of the infrastructure will peak. And all it has to do is start to slow down, let alone peak. The market works off second differential. So as a change in the rate of change starts to slow down, the stocks will peak out. So the companies that are involved in actually building AI, if their orders and their financial results are dependent on continued acceleration of the build-out, it'll prove difficult at some point in time. And again, given the $300 billion that's planned to be spent now, it may happen in a reasonably short period of time. But that's when the ability to generate application software will become the dominant import. And the big hyperscales will still be generating cash flow. It may not be growing at the same rate, but that will matter less as time goes on. So that's the story of Cisco. And I think that's why the businesses they were in, of course, the telecommunication system was building up. We had WorldCom and some other fantastic flameouts. That order structure was simply unsustainable. Just way too much telecommunications capacity was being built.
Well, fun period. As the 90s came to a close, you decided to go hang your own shingle and went Clough Capital. Tell us a little bit about that idea.
Well, that's something that had been in my mind for some time. Being Chief Investment Strategist at Merrill Lynch was very much a travel job, and China was just beginning to evolve as a capitalistic economy. My first trip to China was in the early 80s, and the only cars on the road were police cars and taxi cabs. So I saw that whole generation move, and we followed the behavior of money and credit. So we could always tell when the Fed was tightening without telling you it was tightening. So we could keep it kind of on the right side of the market, but I don't think that was the key. I think the key was that, in fact, I think I can claim I made an entire career on one call, and fortunately it turned out to be successful. That call was interest rates would be declining throughout this period on a long-term basis, even each cycle. You will come out of each cycle with a lower high and a lower low. That call started in 1987, continued right through the 90s, and I think so many individual investors and financial advisors largely served the retail market that turned out to be a very useful call because they could easily create products around, as long as they were convinced that the long-term interest rate trend was down. And I did make that call, and I continue to make that call, by the way, when I talk about that. But that probably was the heart of my career. By the time we get into the late 90s, I've been at it 10 years. And I remember one time I was flying back then you had to go through Tokyo if you went into China. So it was Shanghai, Tokyo, New York. And I was flying over Westchester, and it just seemed to me I was flying over Westchester for hours and hours and hours. And I just wanted to get that plane to the ground. And I thought to myself, I'm getting tired. So that was 1997. I didn't leave till 2000. So I hung around for another 3 years. But it was a great job. My Merrill job was the greatest job I ever had. And I think it was the best job in the world. You knew the smartest investors. It was just a great intellectual experience. And I managed to get along with everybody.
You mentioned China, by the way. China has been such an interesting story, not just about its growth, but the stock market, which for 30 years, other than this recent little run-up, has had almost no returns or pretty close to it. It's like, it reminds me of Japan in the 90s, 2000s. Like, they'll have these little rippers where they'll make 100% or 200%, then go down 50 or 60 or something. What do you think about China as you think about China? I know for a long time you had commented that it was somewhat uninvestable, but is that the same today? How do you feel about it?
I never thought it was uninvestable in the 90s or the 2000s. There was a tremendous transformation on how the Politburo and the president of China felt about it. Zhu Rongji was, I think, a terrific CEO of China at a very critical time. So my first trip was there. It was only several years after Deng Xiaoping really turned it into a market economy. And of course, I saw the whole expansion. It was one of the most exciting human developments to be able to sit and watch and to some extent be part of. That all changed really in 2012 when Xi Jinping became the premier or president. And I'm still astounded watching this whole decade and virtually the destruction of a profit motive and an entrepreneurial spirit. See that happen. I know lots of Chinese folks, especially young people, and they're despondent. And there's just no life for a young person, especially one with aspiration that's looked down upon right now by the government. I never thought he'd last as long as he did. He has. And has continued to double down on some disastrous policies. So we haven't done or thought about China for some time right now. But, we had an office in Hong Kong, and we had a little Chinese mutual fund. And I always think maybe we'll have a chance to start it up again, but it would take a significant change in Chinese leadership. I don't want to use the word insane right now, but I think of the word insane when I see the policies that are being formed there.
Well, let's start to walk towards the present. Your comment earlier, which I think is a really interesting one. Bill Gross talked about this once, where the decision to say, hey, interest rates are coming down was almost like a Rip Van Winkle decision, right? You could make that bet and then just kind of step back with bonds is this very long trend. And there's been few commentators other than yourself, maybe Lacey Hunt and some others, that have really kind of been on that train consistently. But as we hit that zero bound, do you feel this period where we've kind of popped back up a little bit, is this the continuation of a trend? Is it the end of the trend? Is it reversal? As we look at interest rates and inflation, how do you think about this going forward?
I think today there are a lot more opportunities in equities than there are in bonds, largely because now, when I first made that call, bonds were 12, 13, 14%, and today, of course, they're 4%. So the challenge is different, and I'm more interested in what's going to happen at the short end. I think the opportunity is to somehow invest in a sharp decline in short-term interest rates because, of course, they're held up by the Fed. I think the best way to tell my thoughts about interest rates is for 40 years, interest rates and inflation declined from 1982 to, 220, so 2020, so that's 38 years. And there had to be reasons why they did. And so the question is, what were those reasons and have they changed? There were 3 reasons and they have not changed. In fact, they become even more deflationary as we go into the 30s. I think the most important dynamic in an economy that determines the height and shape of a yield curve is demographics. Demographics are an incredibly important dynamic in this. And the reason is, as people age, they save more. There's more savings in an older population than there is in a younger population. And Japan is the best example of that. Japan ran into a point when their capital investment curve collapsed in early 93, grossly overbuilt. The banks were the largest banks in the world. Japan has never had positive real interest rates since that time, despite horrendous, well, people would say horrendous government deficits. I would argue it's a good thing the Bank of Japan was so aggressive to put liquidity in the economy, because the private economy was on its back and government had to make up the difference. But Japan has never had positive real interest rates from that time. I think Europe, especially the currency union, fell into that same time warp in maybe 2013, about the time of the Greek credit crisis. And that's when demographics reached to a point, ameliorated a little bit by the immigration there, but still the dynamic was the Germans were systemic savers anyway. They started to save more than they could invest. And if you save more than invest as an economy, you're going to have a strong currency and low interest rates. If you invest more than you save, as what happened in the baby boomers, you're going to have a cheap currency, a low currency, and you're going to have high interest rates. So now we're beginning to enter that time warp right now, where the economy is about to enter a period, in fact, it already has, where savings exceed investment. And I'll use a couple of anecdotes to make the point. Think of the investment side of it first. I was one of the first analysts to visit Disney World. It was back in December 1972, and a bunch of us analysts flew down to Orlando, and we went through the orange groves and fields, and suddenly this big park showed up in front of us. It was Disney World. And for the next 50 years, if you go up Route 4 from Orlando, ends up in Jacksonville somewhere, there was the infrastructure builder. And that's really what the country's investment is. It's this huge commercial real estate stock and residential real estate stock we built over the last 50 to 70 years. And it went from Orlando for about 30 miles, maybe actually about 50 miles. And there are housing developments and hotels and hospitals and more hotels and more residential. It goes 30 miles and then it stops. And to keep the same level of investment in our economy, you have to build the next 30 miles, and that's not going to happen. And it's not going to happen largely because of demographics. The baby boomers now own 60% of the housing stock. And there's two things that are happening. One, they're going to start to retire. They're very late in retiring. Once you retire, you stop spending. You don't buy houses. You don't buy cars. You may go on a cruise line trip. And I think that's a great area of investment right now because capital assets are kind of fixed and they're becoming very popular. But they don't spend, and that only exacerbates the savings to investment imbalance. Now, the other, of course, is simply where balance sheets ended up. Once you reach the point where private debt equaled about 160% of GDP, and that was in the early 80s, today it's about 150. You can't have high nominal interest rates simply because at high nominal interest rates, you can't service 150% of GDP debt load. Every time the 10-year tries to knock above 5, it gets pushed back. And of course, we're already beginning to see that in the credit card. Right now, in our economy right now, it's a credit card experience that's really sustaining spending, especially among low and medium income people. So credit card rates usually are 12, 13%. Well, in 22, the banks moved them up to 20 to 28%. And those revolving credit balances are growing. Well, now 22 to 28% doubles in 3 years. So you can see the private sector is taking on a huge liability there, and the spending pattern is simply unsustainable. So we kind of think you're at a point now where savings will be forced to exceed investment. And if that's the case, you're going to have low interest rates and a strong dollar. And we're kind of seeing that right now. I mean, the big concern that most investors claim they have, and you hear it expressed on Wall Street a lot, is that because government deficits, we're going to have a weak currency and higher interest rates. And quite the opposite is happening. And it's a good thing it's happening because if you look at Japan, government deficits were extremely high, but the private sector was saving, and that means you weren't really creating much young liquidity. And the same thing is happening today. Look how strong the dollar is. In fact, if you look at liquidity and how it's affecting our markets, look how narrow the quality spreads are. Triple B's never got much above, I don't know how many bond funds were formed over the last several years, hoping for more distressed rates, but you never got them. The triple B level is about 60 basis points over the government. So I think the way we'll find it works out is that as we save more than we invest, the government can borrow. and it can borrow without the deleterious effects people are saying, because the private sector is actually liquidating credit. You can't get on a conference call today without the management saying we're reducing our debt. Government debt's about 33 trillion, private debt's about 49 trillion. So that 49 trillion is falling as a percent of GDP faster than that government sector is growing. That's why the dollar is so strong, because we're not creating as much dollar liquidity as people think. It has profound implications because right now in the Fed flow of funds data, they tell you how much liquid assets are in the household sector, and it's got to be approaching $50 trillion. The economy is only 28 trillion. So that's a tremendous amount of liquidity. It's stuck at the short end of the yield curve. It may take a little longer than people think, but that doesn't matter how long it takes, because the market will ignore it anyway. Think of how stocks have behaved in the face of both an easier and a tight Fed. But if I told you 2 or 3 years ago that the Fed was going to increase interest rates 500 basis points and pull back the size of its balance sheet from 9 to 7 trillion, most people would have assumed stocks would decline. They didn't. Not only did they go up, they boomed. So stocks boomed in the face of those two events. And I suspect that only becomes even greater pressure on equities as time goes on. So we are going to save. We're going to save more because of who we are as a demographic, and we're going to liquidate balance sheets. And the final point in the thought process is that the banking system is responding to that. Total deposits in the banking system were $20.5 trillion 2.5 years ago. They're about to break $18 trillion. They're about to have a 17 handle on it. So the banking system is liquidating its deposits. And I think if you go on the website of any of the money center banks and ask, what is the interest rate, the yield they're willing to pay on a normal demand deposit, I think you'll find it's about 10 basis points. And the signal from that is that the banking system is not trying to grow its deposits because it doesn't have the lending opportunities to match, because they're holding on to more savings than it's possible to invest in it. So that's the thesis. It would show up eventually in more downward pressure on the short end of the curve. And I suspect long-term, it's bullish for equities because that's the only part of the economy that really generates free cash flow.
That's the important word, free cash flow. How do you think about productivity? You know, everyone's like the word cloud of 2025 might be austerity, government, Doge, but also the AI boom that's happening around us. How do you kind of think or factor that in as far as productivity improvements? Any other second, third order implications too?
Well, productivity equals profits. So it's obviously profit supportive and equity supportive, but it's easy to measure. People try to do it one of two ways. They try to do it anecdotally, and it's hard to measure anecdotally, but there is one measure you can look at. Actually, when you talk about productivity, you're talking about labor productivity. So total hours worked actually have been declining for several years. In fact, they're 1% or 2% lower than they were in 2019. In fact, in this morning's labor report, costs were up a little bit. It looked like a kind of a too hawkish or too fast report, but labor hours worked actually was down. And that means we're turning from a full-time employment to a part-time in part. People are moving from full-time at the margin, full-time to part-time. That eventually is a sign that we are becoming more productive. The best way to look at that is simply nominal GDP. Nominal GDP is probably up 8 or 9%. Could be more. I haven't looked at it lately since 2019. So if we're getting 8 or 10% more nominal GDP at lower labor hours worked, and we really haven't had the effect of AI yet. So those are three: demographics, the fact that balance sheets have to be delevered, and thirdly, labor productivity suggests there's a deflationary world ahead, and the bond market's probably an okay place to be. But the real opportunity is finding ways to invest in a decline in short-term interest rates.
Perfect. Well, let's hear it. You mentioned cruise lines. It's funny. I was watching a commercial the other day, and I was always like, these mega cruise ships always look like my worst nightmare. I got a 7-year-old though, and we were watching a commercial, and I was like, that actually looks sort of fun. I don't know. Now the key is talking my wife into doing it, which she is a strong no against. But you mentioned cruise lines. You're welcome to talk about those, or also talk about any other big opportunities you're seeing in the equity sectors here 2025.
I made the point about how I think the hyperscale technology event will work out. And that's one element of a portfolio that I still think there should be some exposure there. We've never had a dynamic in the economy where free cash flow can be compounded out at such a rate. But there are some areas where we have shortages. The price-cost relationship is going to improve. And in a market with the liquidity we have, there's going to be opportunity. I still think the most interesting industry, which is undergoing some restructuring, As it happens, it's probably entering 20 years of boom times as a defense aerospace industry. In the commercial airline, we only have 2 builders of aircraft, and I don't think anybody's going to touch them for a while. And all they have to do is correct their supply lines. Once Boeing corrects its supply line issues, it's a very strong cash-generating institution again. So I think both Boeing and Airbus, we just know we're going to need more airliners as we go through the next decade, and the backlogs already stretch into the next decade. And I think the same true is always also on the defense side as well. In fact, I think the Pentagon is beginning to realize that it needs an efficient, effective, and profitable defense infrastructure, and I think the authorization process will adjust to that. The cruise line story is an interesting one, and I'll tell you where the idea originally came from. Another Chicago economist named Merton Miller won a Nobel Prize in 1981. It was combined with Franco Modigliani at MIT at the time, and it was called the Miller-Modigliani thesis, and if you had any graduate training in business, you heard of it. And it was actually another brilliant insight, and the insight was you can't change the value of a firm by changing the debt-equity ratio. And out of that came junk bonds, out of that came index funds, out of that came so many transformations in the financial world. But it's true, if you increase debt, your value of the equity is going to go down as a percentage of capitalization. And if you reduce debt, the value of the equity is going to come up. Well, what are the industries that had built tremendous debt on their balance sheets? They had basically strong business models and strong cash flow models, but were closed. And one is Boeing, of course, as an example for a number of reasons. But the biggest one was the cruise lines. They shut them down. The CD shut them down for 2 years. And through some of the cleverest ways of human intuition, they managed to survive, but of course they came out of it with extremely leveraged balance sheets. If you're looking at Carnival, where stock was 72 at one time, it ended up at 8. And Royal Caribbean, I forgot quite what the numbers were, but I think it was 50 and 12. So the equities were quite depressed because the balance sheet was so leveraged. But we're coming into a period of time where we're about to see a boom, and younger families were suddenly, it was usually an industry mostly patronized by older folks, but suddenly families come and you get these new Royal Caribbean ships that have Carnivals on them. So our sense is that demand would be good. It has been good. They're already booking for 26, and the cash flow is high as that is paid down. In the case of Carnival, I want to say a debt probably peaked at $33 billion. It's 29 today. If it gets to 25, they're investment grade. Stock's 25. It was 72. I don't know why I can't get back there. So I suspect that this is an industry because it does give a family a very good experience at a fraction of the cost that Disney World experience would be. So it just looked to us like it was the one part of the leisure and entertainment world that had a number of things going for them. And we think it still does. There's a natural gas story. The shortage showed up when Russia invaded Ukraine, and there's an LNG development that's come from that. It increases demand for natural gas by 20%, and the Permian is kind of depleted. So you've got a good cost relationship that probably means demand for natural gas will go up. I think there's a good story there.
Well, natural gas is interesting because that was a commodity that in the early 2000s, it almost looks like a VIX chart or corporate bond spread or something where like every once in a while it'll just do this face ripper where it goes from 2 or 3 up to 6, 8, 10, 12, 14, and then often comes back down. But you have these periods of kind of relative calm overlaid with these giant runs up. We're kind of at the lower levels of nat gas, or 3 and change, I think, today. But there's been periods where it's been multiples higher than it is currently.
Well, it's an industry where supply can be very volatile. And if supply can be volatile and there's price elasticity, you're going to have the kind of volatile price behavior you saw. There is a difference. And the difference is, well, what made the volatility occur especially the downward volatility, was the development of the Permian and the Eagle Ford fields. They're kind of used up, not totally, but cost a little bit more to generate large increases in production. And of course, most of the companies have been forced to become a little bit more shareholder friendly and more concentration on free cash flow and dividends. So I think you put those two things together, it's a little harder for the supply side to respond so quickly. But that natural gas, there may be a glut later in the decade because the number of trains, the so-called plants for these things, are proliferating, and a tremendous amount of money is going into it. So it's kind of like the fiber loops in Boston, maybe, but that's a few years out. In the meantime, there's going to be acceleration of demand. So it looks like the industry is going to use capital for a while, and if the industry can use capital efficiently for a while, there'll be some opportunities in the stock market.
I see you mentioned kind of one other area when you talk about AI Any particular companies you like there? I know you mentioned device manufacturers.
That's the first instinct that people have. Who are the users, the beneficiaries of it? And the idea is that the users of technology will be where the benefits are. The last time I saw that that was true was the emergence of jet aircraft in the 60s. Because jet aircraft were so efficient, I mean, you could go from New York to Paris without stopping at Greenland. There's no question. The banks are becoming more efficient with technology generally, and the banks that have spent the most on technology are the ones that held up the best. But it's not clear that it actually turns into profits because everybody has the same access to it. And I guess the best example I can think of is, let's take 5G. When 5G came along, a material step up in the power of telecommunications, particularly in the wireless world. But AT&T and Verizon never did much. The actual final user didn't get any efficiencies out of it. We just created capacity because they had to create enough capacity to offer the service, and the service demand never caught up with the capacity. So that's an area that people who are used AI, Palantir, and there are a few stocks like that that have emerged, but they're finding ways to actually develop software in an AI form for a specific market, and there'll be successes in that frame. But the idea that banks will suddenly generate huge amounts of profits because they'll generate AI leaves out the fact that this is a very price elastic industry, very sensitive to what deposit rates are. And it's an industry in structural oversupply. Now let's look at the other side of the equation. What industries will not benefit from AI? And I would argue the financial sector is probably the best example because it just adds a tremendous amount of capacity to an industry that is in a situation where it already cannot leverage its deposits. The banking system has $18 trillion of deposits, which cannot be leveraged. Net interest income didn't really grow, even though the curve steepened a little bit. They made money in the capital markets business, but that's also a hotly competitive business. And so it looks to me like AI, because it makes everybody more efficient, just brings the price level down for the customer. I'm not sure that there are all sorts of secret ways that the economy will benefit from AI. Particular companies might, and Palantir is perhaps today's child, but when the internet emerged, it was funny. It wasn't people who had websites that made. You had to wait for the development of Google and Amazon, and then ultimately Meta, all of which were developed between 2004 and 2012, and they actually captured the profits. And the semiconductor manufacturers did as well. So I suspect the companies that will actually be the huge beneficiaries of artificial intelligence haven't been formed yet.
Yeah, it's going to be fun to watch. Let's jump around a few kind of short questions as we wind down the time we have with you. As you look back on your career, the hundreds, if not thousands of trades and ideas you've had, has there been a most memorable investment over the decades that's just burned into your brain?
That's dangerous. It's a spectacular investment. My first lumber investment, I made 5 times on my money in a matter of weeks. It's like an addiction. You want to do this again. So sometimes a great investment like that makes it more difficult. You have to have a diversity of investments to be reasonably successful in this business. But I would say the same thing I said earlier. I had one good idea, and that was interest rates are going down. I started in 1987, so here we are in 2027. It'll be 40 years for 36, 37 years. It's the best idea I ever had. Interest rates are still going down. The short end will be at 1% sometime in the next few years, and the long end, the 10-year, will be at 2.5%. It'll sit there forever.
Oh boy, that's a hot take. I like it. Well, you listening, bond investors?
We're older. We're getting older. We're saving more than we're investing. As academic as that sounds, it's the most important dynamic in the economic backdrop. The private population is saving more than the government can possibly spend.
If you sit down with a group of your peers, you're getting coffee, walking around, having lunch, whatever it is, but it's a bunch of CIOs, presidents, strategists of investing firms, what's a belief that you have that probably most of them would disagree with?
Well, I'd say one thing, the ideas I just expressed today are non-consensus. Now, they can turn consensus in a heartbeat. A couple of weak data points from the government will change everybody's idea back to the government's going to conceive. I think those points come up occasionally. Like, for example, when President Trump announced all these tariffs, and he did it suddenly, and he did it in a very aggressive form. And of course, the market for a while collapsed, but then caught itself and come back, as it always does. It catches itself and come back. And that's a respectful of the liquidity that's out there. But the general consensus among everybody was that this would be inflationary. And yet, if you go back to 2017, when then President Trump inaugurated a number of tariffs, and you go out 2 years from that to 2019, Fed funds were at 1.6%, the 2-year was at 1.76%, and the 10-year was at 1.7%. So tariffs don't matter, at least in an inflationary sense, because if one thing, there are substitution effects. Let's look at the aggregate here. Right now, manufacturing of the economy, 12% of the economy is manufacturing. 3% is imports. And so it's going to be some set of 3% that matters here. There will be substitution effects. There will be countries, there's 15,000 ways to get goods into the United States, and we'll find every one of them. So I think the Smoot-Hawley tariff and some of the famous experiences in history, it was a different economy, and I'm not sure that had as big an impact as is commonly believed, because the monetary policy was kind of mucked up then too. But I think that's probably the latest one where it's easy to see reason to be anti-consensus, but consensus is still, I found that yesterday visiting some clients. Sometimes a singular idea about how the economy works can be active in many, many different sectors here. But I would say that's the most recent experience where my view of things would be different than the consensus.
What do you think's been the biggest surprise over the last 10 years or so? To me, seeing interest rates that got to zero and negative was definitely, I felt like a curious time. I feel like markets are always surprising us, but anything that you looked around and said, man, that was a weird time, or this wasn't something I was expecting.
I think what happens is you're not surprised at something happening. You're surprised it's happening to the extent it has, and you've completely underestimated the impact. And I would say the most recent example of that, which really held our firm back a little bit, was in August of 2013. If you go back and look at a chart, Google, I think, went public in 2008 or so, 2007, 2008, had a run and then just died, and really flat performance for years. And then suddenly in August of 2013, it broke out. And I said to myself, technology is coming back in some way. And I couldn't quite figure out which way or form. But that was the first breakout in technology, which of course captured all of the things as time went on. It also combined with the emergence of indexing, combining indices into an ETF or mutual fund and selling the index. And from that moment on, I think for several years, we underperformed the S&P simply because we didn't capture that dynamic, even though we knew what was happening. We knew about indexing and we knew about how big, but it was hard to turn a portfolio around. That's just one of my own personal mistakes. But I say that was one thing I noticed, and I think people are more likely to, because everybody knows what's going. The information flow is humongous. But the biggest thing is understanding the implications, especially how big a factor could be. So you had the combination of the FANGs developing huge market capitalizations, ultimately dominated the index. And it means if you weren't invested in those, you're going to underperform the S&P. Took a while for me to figure that out. And I knew the moment it started, and of course we knew indexing, but we never thought it would become as dominant as it was. And turned out to be one of the great inventions in human financial markets is the ability to index and probably beat everybody else.
Yeah, well said. We wrote a piece last year called The Bear Market and Diversification on that topic alone, about how the S&P, no matter what portfolio did, 60-40, endowment, permanent, on, you got creamed by the S&P for the past 15 years, but not just creamed by the S&P on an absolute level, but creamed by the S&P years in a row. It's like 14 of 15 years or something. For a lot of people, that's hard. They don't want to underperform their neighbor who's just dollar cost averaging into SPY or whatever they may be.
The other is the whole battle between growth and value. Value hasn't worked for a long time. And if you look at the dominant factors that are going on right now, it may still not. Productivity means profits, but it probably means profits for the larger companies rather than the smaller companies, because the larger companies have scale to be able to use that technology.
It's funny, as I mentioned SPY, because you were at Merrill when some of these sector spiders came out, and here we are full circle, Chuck. You now got a couple ETFs, CBLS, CBSE, Vincent LaRusso involved over there at Clough Capital. You even do a little shorting, which, I mean, 2025, I feel like all the short sellers are retired or in the cemetery at this point. And we have a very soft spot for anyone that does shorting, but it's a hard business. How do you think about the ETF space?
Well, both of our ETFs are net long. CBSE is long, and CBLS is maybe 50 or 60% net long. So it is a net long shop. But every once in a while, you see a company out there with bad management, bad business plans, bad balance sheets, no cash flow, and we just can't help ourselves. We've got to be able to exploit that insight. The market's been a bull market for a terribly long period of time. So obviously there are some hills to climb, but there are two themes out there that are kind of different than just, they're far apart from indexing as you can imagine. One, of course, is small stocks or small and medium stock. And the second is short selling. The thing about the both of them is they're very, very, very difficult to do. I mean, to really invest in small stocks, you have to come up with individual special situations. And that's hard to do, and it's hard to build a portfolio out of it. And there aren't that many small, medium cap managers left as an fiduciary in the endowment space. I can see it. The people who did well in the 70s and 80s, of course, as you point out, are not here. And the other thing would be short selling. It's hard to do, which means there are opportunities. Obviously, the fact that it's hard to do means not everybody's trying to do it. It is a way to bring some diversity to the portfolio, certainly some hedging, but you have to keep your short book pretty small in this market. But that's simply because of the trend of the market. Of course, short sellers always come out of the woodwork when there's a bear market and the trend is with you. But in my world, if we're right and the economy will be throwing off excess liquidity for the next decade or two, I suspect short selling will be challenging. But when you catch something, it can be very profitable. Our short book actually was pretty good last year. It wasn't, and it turned out to be a good year. But it's a lot of work, and you have to be very resourceful.
You got to be mindful. Those positions can move. It can be painful. We always joke when we talk about longs and shorts approaches. We say you got twice as many chances now to be right and wrong. That's good. That's good. It's good and it's bad. See?
Yeah, at least in a long, there's limited downside. In a short, there is not.
You work with some amazing names at Merrill over the years, Bob Farrell, Richard Bernstein. Any particular memories, stories, lessons from some of these cast of characters that you've got to interact with over the years?
Yeah, I mean, Bob Farrell and I, of course, worked at opposite corners of the 19th floor at the World Financial Center, and a remarkable individual and a wonderful, wonderful, wonderful guy. We had a lot of fun together. He was late in his. He'd already had decades of fame. So I was very proud and happy to work with him, and we developed a strong personal relationship, as you might imagine. Richard Bernstein, I brought him into Merrill Lynch. I think it was in 1989, and really very, very smart and resourceful young man. And of course, he's been phenomenally successful, and I'm so happy to see that. A lot of the other Merrill Lynch folks that I got to know, of course, were the FAs, because ordinarily the chief investment strategist doesn't do a lot with the retail side of the business, because my responsibility was to service Fidelity and Putnam and the mutual fund giants of the time. But one day I decided to make a presentation to several offices got together, and they filled a hotel ballroom with maybe 300 or 400 people. And I went on, babbled on for half an hour, maybe 35, 40 minutes. And I looked at the people, and they're mostly elderly, some middle-aged, but a lot of elderly folks. They brought their notebooks, and they were taking down everything I said. And I thought to myself, this is the heart of the business. This is the real business. This is savings. It's not somebody managing somebody else's money. It's savings. They're saving for retirement. They're saving for kids. And I was just moved by that. And I did a lot of it. In fact, I understand I was the first investment strategist that ever did a lot of it. And of course, Merrill, with the thundering herd, had plenty of places to talk. But I remember standing outside one place, I think it was in Birmingham, Alabama. I don't know how I ended up down there, but I did. And I sat outside for a few minutes watching the people came in, and I said, what an honor that they're coming to listen to me. But I understand personal investing is very serious business. Merrill had great financial advisors, still does. And it was the highlight of my career. It just plain was. Watching those people and being able to do the service of bringing the capital markets or the stock markets to them in a way, hopefully, that was understandable. And that must have been partially successful because they kept showing up.
Chuck, it's been a blast. We've kept you long enough. We'd love to keep you all day. Thanks so much for joining us today.
Let's do it again sometime.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes, and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.